Section 751 is the IRS saying, nice try. You can't convert ordinary income into capital gain just by moving partnership assets around. The rule targets hot assets, meaning assets that would produce ordinary income if the partnership sold them. When a partner receives hot assets in a distribution or sells their partnership interest, part of what looks like capital gain gets recharacterized as ordinary income. On the EA exam, they usually keep the hot asset list simple. The big two are unrealized receivables and inventory. Unrealized receivables include things like accounts receivable for a cash-basis service partnership or recapture-type items in some cases. Inventory is hot because selling it normally creates ordinary income, not capital gain. So the IRS keeps that character even after a distribution or sale. Here's the core idea. If the partnership would have ordinary income on a sale, you don't get to turn it into capital gain by taking the asset personally. So if you receive unrealized receivables in a distribution and later collect them, that collection is ordinary income to you. Same vibe with inventory. If you later sell distributed inventory, the gain is generally ordinary because it would have been ordinary inside the partnership. Use the accounting firm example. Triple Crown liquidates and distributes $30,000 of unrealized receivables to Dylan. Next year, clients pay those invoices and Dylan gets the cash. That's ordinary income to Dylan. The partnership would have had ordinary income if it collected the receivables. So Dylan has ordinary income when he collects. The exam loves this because it feels unfair, but it's consistent. Quick contrast. Not every distribution triggers income. In a normal distribution, you're usually limited by outside basis, and you often recognize no gain unless cash exceeds outside basis. Like the farmland example, cash plus property reduces outside basis, and the property basis can be limited. But hot assets are different because the issue isn't basis first, it's character. Section 751 is about ordinary versus capital. Which of the following is not an acceptable inventory method for federal tax purposes? The choices include an allocation method, LIFO, specific identification, and FIFO. Remember, the IRS recognizes certain inventory costing methods, and the exam expects you to know the standard list. Think about it. The correct answer is the allocation method. FIFO, LIFO, and specific identification are all acceptable inventory methods. Allocation method sounds plausible because businesses allocate costs all the time, but it's not one of the recognized inventory methods for federal tax purposes. On the exam, when you see FIFO, LIFO, and specific ID together, they're usually the legitimate ones. A partner sells a partnership interest at a gain. They generally report all the gain in the year of sale unless the sale is treated as something special. The options include an opportunity zone conversion, a Section 1031 exchange, an involuntary conversion, or an installment sale. Which one allows spreading the gain over time? Think about it. The correct answer is an installment sale. A partnership interest can qualify for installment reporting, so gain is recognized as payments are received. The tempting wrong answer is Section 1031 because people associate it with deferring gain, but partnership interests are specifically excluded from like-kind exchange treatment. Also remember, even with an installment sale, the hot asset piece under Section 751 can still be ordinary income.